You check your bank balance on a Tuesday morning. The number looks safe. The screen glows with a comforting array of digits that tells you your savings are secure. It feels like stability. But what if that number is lying to you? For the last few years, you have been playing a rigged game. You thought the financial chaos was over. The media told you the economy was finally returning to normal. Then 2026 arrived, and suddenly, everyday prices started creeping up all over again. What is actually happening to your money? Inflation is back in the system. It is not a dramatic, headline-grabbing hyperinflation. It is a quiet, persistent drain on your wallet. As of mid-2026, headline inflation is pushing past 4.2%. It does not sound like a crisis, but it is an invisible crisis. How does a 4.2% inflation rate actually destroy wealth? Let's decode this. Inflation is simply the rate at which the general price of goods and services rises. This means every dollar you own buys a little bit less. The government tracks this using the Consumer Price Index, or CPI. The CPI measures a theoretical basket of goods that a typical American buys, like food, housing, and transportation. When the CPI goes up, your purchasing power goes down. Purchasing power is the actual, physical amount of stuff your money can buy in the real world. Do you remember what groceries cost just 5 years ago? That memory gap is a documented psychological flaw. Behavioral economist Daniel Kahneman described this when studying how our brains process financial pain. Kahneman proved that human beings are terrible at calculating gradual, invisible losses. We suffer from a cognitive blind spot called money illusion. Money illusion means you look at your paycheck. You see the nominal number has gone up, and you feel richer. A nominal return is just the raw percentage your money grew on paper, completely ignoring the cost of living. But your brain ignores the silent decay of what those dollars can actually purchase. Why do we keep falling for this mathematical trick? Because the system is designed to make you look at the wrong numbers. The Federal Reserve is the central banking system of the United States. They have a stated inflation target of 2%. They actively want your money to lose 2% of its value every single year. But in 2026, driven by new tariffs and global energy shocks, the inflation rate has doubled their target. Famous economist Milton Friedman once warned that inflation is taxation without legislation. He meant that governments can drain your wealth to pay for their massive debts without ever passing a new tax law. They just print more currency, dilute the money supply, and let your savings pay the ultimate price. Are you starting to feel the squeeze yet? Let us reconstruct your path to wealth right now. You are doing everything the traditional financial advisors told you to do. You work hard every day. You cut back on unnecessary expenses. You manage to save $10,000. And you put it into a high-yield savings account. You feel responsible. Your bank is paying you a 4% interest rate. You check the app and see the nominal balance going up every month. You earned $400 this year just for leaving your money alone. You feel like a financial genius. But are you actually getting ahead? Let us apply the painful twist. Your savings account is actually losing you money. Let me repeat that, because your brain is naturally trained to reject it. Your high-yield savings account is currently bleeding your wealth dry. How is that mathematically possible? It all comes down to the real yield. The real yield is the return on your investment after you subtract the current rate of inflation. If your bank pays you 4%, but the 2026 inflation rate is 4.2%, your real yield is negative 0.2%. You are not making money. You are safely and predictably locking in a guaranteed loss of purchasing power. The bank is taking your $10,000, lending it out at 7%, and paying you back in a currency that is losing value even faster. Who is really winning this transaction? This is the hidden mechanics of the modern financial machine. Jack Bogle is the legendary investor who founded Vanguard and created the first index fund. He warned everyday investors about this exact psychological trap. He called inflation the silent tax that ravages the miracle of compounding. Compounding interest is when the money you earn generates even more money over time. It is considered the greatest wealth-building tool in human history. But Bogle understood that compounding works in reverse too. If inflation outpaces your returns, your purchasing power compounds downward into poverty. Do you see why the wealthy never leave their money in cash? Let us look closely at your paycheck. The average worker in 2026 is actually experiencing a decrease in real weekly earnings. Your boss gave you a 3% raise this year, but you are poorer today than you were 12 months ago. Your wages are sticky, Sticky wages is an economic term meaning that salaries are painfully slow to adjust upward to match sudden increases in the cost of living. Corporations are incredibly fast to raise the prices of their products, but they are incredibly slow to raise the salaries of their employees. Who absorbs that financial difference? You do. To bridge the gap between stagnant wages and rising prices, you turn to plastic. You swipe your credit card. At first, it is just for emergencies. Then, it is for daily groceries. Soon, you are carrying a revolving balance from month to month. A revolving balance is the portion of your credit card debt that you do not pay off, which then begins accumulating severe interest. This is where the inflation trap snaps completely shut. The Federal Reserve has maintained higher interest rates to fight the 2026 inflation spike. Because of this, the interest rate on your credit card has skyrocketed. The average credit card now charges over 22% annual percentage rate, or APR. APR is the total yearly cost of borrowing money, including interest and hidden fees. So, your cash is losing 2% of its value to inflation. Meanwhile, your debt is compounding at 22% against you. You are being squeezed aggressively from both sides. Your assets are shrinking in real value, and your liabilities are expanding at an exponential rate. How long can middle-class wallets survive that kind of pressure? Let us dive deeper into the history of this silent tax. In the late 1970s and early 1980s, the United States faced an inflation crisis that dwarfed what we are seeing today. Prices were rising by over 14% a year. The chairman of the Federal Reserve at the time was Paul Volcker. Volcker had to take drastic, painful action to save the economy. He aggressively raised interest rates all the way to 20%. It triggered a massive global recession. It crushed small businesses and caused unemployment to spike to record levels. But it was the only way to break the psychological fever of inflation. Why was this psychological shift so absolutely necessary? Because inflation is not just a math problem. It is a behavioral virus. When people believe prices will keep rising, they rush out to buy things today before they become more expensive tomorrow. This sudden surge in demand allows corporations to raise prices even further. This creates a self-fulfilling economic prophecy known as an inflationary spiral. Today, in 2026, we are not anywhere near 14%, but the psychological virus is slowly creeping back into the American consumer. You see it at the grocery store, at the gas pump, and in your rent bill. You feel a quiet urgency to spend your money before it becomes entirely worthless. Are you unknowingly participating in the spiral? Let's look at how the wealthy play this exact same game. When inflation spikes, the middle class panics and clutches their cash. The wealthy do the exact opposite. They understand that inflation destroys the value of fiat currency. Fiat currency is money, backed by a government, rather than a physical commodity like gold. So, the wealthy trade their depreciating fiat currency for hard assets. Hard assets are tangible things that hold intrinsic value and tend to rise in price along with inflation. Real estate, equities, commodities, successful businesses. When you buy an index fund, you are buying tiny slices of real global businesses. An index fund is a passive investment that tracks the performance of the entire stock market. If the cost of goods goes up, those businesses naturally raise their prices. Their revenues increase in nominal terms. Their stock prices generally adjust upward to reflect that new inflationary reality. This is why the stock market acts as an imperfect but historically reliable hedge against inflation. A hedge is simply a financial defense mechanism designed to protect your wealth from adverse economic events. Do you have any hedges in place right now, or are you sitting entirely in cash, hoping the central bank will swoop in and save you? Let us examine what happens if the 2026 inflation rate becomes the new normal. Imagine a scenario where inflation averages 4% for the next 2 decades. It does not sound apocalyptic. It sounds almost manageable, but let us run the brutal math on your purchasing power. At a 4% annual inflation rate, the cost of living doubles every 18 years. That means your current salary, your retirement target, and your emergency fund will literally be cut in half. They will lose 50% of what they can actually buy in the real world. If you think you need $1 million to retire comfortably, you are wrong. An 18-year stretch of 4% inflation means you will actually need $2 million just to maintain the exact same lifestyle. The goalpost is not just moving. The goalpost is attached to a rocket ship. How do you catch a financial target that is constantly accelerating away from you? You stop playing the game by their outdated rules. You stop measuring your wealth in nominal dollars. You start measuring your wealth in true purchasing power. You must recognize that saving your money is no longer enough. Saving is purely defensive. Investing is highly offensive. And in an inflationary environment, a pure defense will get you slaughtered. You need to allocate your capital into vehicles that can aggressively outpace the hidden tax. This does not mean gambling on speculative crypto tokens or meme stocks. It means adopting a passive investing strategy. Passive investing is the practice of buying broad market index funds and holding them for decades. You completely ignore the day-to-day noise of the market. It is boring, it is slow, but it is mathematically resilient against the erosion of your money. Let us mirror this back onto your daily habits right now. You go to the store and swipe your card for a premium coffee. The price is 50 cents higher than it was a year ago. You notice the increase, but you swipe anyway, because it is just 50 cents. What you do not realize is that the 50 cents represents a massive macroeconomic shift. It represents global supply chains permanently restructuring. It represents the Federal Reserve desperately wrestling with interest rates. It represents the invisible tax of inflation, silently extracting wealth from the middle class and transferring it to the asset-owning class. Every time you hold cash instead of assets, you are paying that tax. Every time you celebrate a 4% yield in a 4-2% inflation environment, you are falling for the money illusion. The system actively relies on your financial illiteracy. It relies on you trusting the comforting glow of the nominal digits on your banking app. The numbers go up, so you naturally feel safe, but you are not safe. The economy of 2026 is punishing the passive saver. It is rewarding the active owner. The longer you wait to understand this, the more of your wealth simply evaporates into the thin air. You check your bank balance on a Tuesday morning. The number looks safe, but you finally realize that the number is lying to you.